Stocks around the world are plummeting this morning, with the Dow tumbling more than 1,000 points. The Nasdaq fell 6.2% after markets opened, and the S&P fell 4.2%. Plus, Japanese stocks suffered their biggest daily loss ever on Monday, with the Nikkei 2025 index closing over 12% lower. The tumbling stocks follow mounting concerns over the strength of the U.S. economy. Friday's July federal jobs report came back much weaker than expected, with the unemployment rate rising to 4.3%. Joining us now to break it all down is the Hill's business editor, Sylvan Lane. Welcome back to Rising.
Thanks for having me.
So let us know what is going on. Is it obvious or apparent, what is driving this this collapse, and are we in for even worse news in coming days?
So to start with your second point first, the silver lining here is that while the stock market opened with a bunch of serious losses this morning, it seems that Wall Street is kind of reeling it in a little bit. These losses are getting a little bit smaller at this point, but investors are clearly worried about the durability of the U.S. economy. As you mentioned, the Friday jobs report came in a bit weaker than was widely expected. And this is amid concern about whether or not the Fed should have cut interest rates earlier than they have. We're in a situation now where the Fed is keeping rates at a pretty high level, meant to keep the economy from overloading. But we're in a situation right now where inflation is coming down, the job market is getting a bit weaker, and there are more worries now than there were before that the Fed may be a little bit too slow to catch up to that.
We've also seen Warren Buffett made some dramatic decisions around Berkshire Hathaway's investments. A lot of people pay attention to Warren Buffett and what he's doing with his money as an indication of what they should do with theirs. I'm wondering if some of this instability is perceived in a way that it doesn't actually exist in the economy. Because while I can understand investors not being hopeful in a high interest rate environment for the near future of the economy, our productive capacity has proven to be pretty resilient even throughout COVID. So how much of this is, investors manifesting an economic downturn?
I think it's a great point about how a lot of what we're seeing right now is more focused on investor concerns about the future than any sort of main or real weakness we're seeing in the economy right now. Even though the Friday jobs report was a bit disappointing, 114,000 new jobs and a 4.3% unemployment rate are not bad at all. They're just a little bit worse than economists expected. And another good thing to keep in mind here is that a lot of today's losses are driven by these technology stocks like Apple that have had these insane increases over the past year or so. So a lot of this is just investors kind of unwinding these big bets they've made so far, maybe cashing out on them with an eye toward investing in other realms that might be a little bit more profitable going on into 2024. So while the stock market could be seen as a harbinger of things to come, but I think it's way too early right now to declare us in any sort of crisis.
That jobs report was very interesting to me because the higher interest rates being pushed by the Fed and Jerome Powell are explicitly to address what they perceive as heat in the labor market, that it's too hot. And the way they believe this works is that you raise interest rates, you discourage investment into business and people starting new ones, because the capital, if it's more expensive, less people are inclined to do it. And so that means there will be less jobs available. When there's less jobs available, there's less ability for workers to negotiate for higher salaries and higher wages. That's what they're trying to address with these high interest rates. So to some degree, is slower job growth the explicit policy right now of the Federal Reserve? That's kind of what they were going for, is it not?
They're not going to say that explicitly, but everybody knows that when the Federal Reserve is hiking interest rates, they're trying to slow the labor market down. Now, there's a lot of ways that could happen. That's fewer jobs added. That's wages not going up as quick as they were before. In the worst case scenario, it's companies laying off employees and the economy losing jobs on the whole. We're not there yet. We don't seem to be particularly close. But yeah, 114,000 jobs added in July or whatever month it may be, after the record-breaking job gains we saw while inflation was going high. There's a bit of this to be expected and welcomed. The key thing here is making sure that the economy doesn't go from slowing into a full stop.
Right. Recession with a capital R is what everyone is fearing. We've been through this a couple times now in the previous decades. Is it going to be willed into existence the more people do start to worry about it? Or, should these, when you hear people in charge, officials say, oh, no, it's just slowing down a little bit. Nobody panic. Everything's fine. They said that all the other times when then it did, progress into a full-blown recession.
I think it's good to keep in mind here that throughout 2022, there were these widespread predictions that the U.S. economy would be roiled with recession in 2023. That didn't happen. We had an extraordinarily strong year of job growth, extraordinarily strong year of economic growth. And all of the people who were, predicting recession and economic doom ended up looking a little bit foolish. That being said, it's always important to take things like this day by day, hour by hour, and look at the fundamentals that's driving what's going on here. A lot of this is tech companies not being as profitable as they were, but they were pretty darn profitable before. People are starting to become a little bit more skeptical that AI is going to be this, massive economic, game changer immediately. But this is already after NVIDIA reached a $3-4 trillion market cap. It's important to kind of take it step by step when deciding whether or not, we're in a crisis or not. But right now we're seeing signs that this might be more of an investor reaction to what has already happened than deep, deep concerns about a crisis ahead of us.
What we're seeing in the crypto market over the last 24 hours is mass liquidation. It's now exceeded $1 billion worth of assets held in various cryptocurrencies being liquidated. What do you make of this as an indicator of how people feel about markets? Because while some people see crypto as currency, I think a lot of investors see it more as an investment than any kind of alternative to money in the form of fiat, like US dollars or yen.
That's exactly right. Now, while Bitcoin and other cryptocurrencies may be designed to, insulate people from the stock market or from the rising and falling of the US dollar, in reality, a lot of cryptocurrencies move in the same direction as stocks. When stocks are going higher, cryptocurrencies are going higher, and often the reverse. And a lot of that reflects the fact that these cryptocurrencies, they're newer, they're a little bit riskier in a lot of cases, there's less known about them, and people are more likely to buy into crypto as the general public. We're not talking about the true believers here. The general public kind of sees crypto as another thing you might be able to invest in. So I think a lot of what we're seeing in the crypto market today is just linked to these broader concerns about the global economy.
Sylvan, thank you so much for joining us. We really appreciate it.
My pleasure.